Welcome to this lecture on financial technical analysis, where we will explore the moving average convergence divergence, or MACD indicator. The MACD is a powerful momentum and trend-following indicator developed by Gerald Appel, designed to help traders identify changes in a trend's strength, direction, momentum, and duration. It combines elements of both moving averages and oscillators, making it one of the most versatile tools in technical analysis for understanding market dynamics. The MACD is calculated using three exponential moving averages: the 12-day EMA for short-term trends, the 26-day EMA for long-term trends, and the 9-day EMA of the MACD line itself, which serves as the signal line. The MACD line is simply the difference between the 12-day and 26-day EMA, while the signal line is the 9-day EMA of this MACD line. The histogram, which visually represents the difference between the MACD line and the signal line, provides further insight into momentum. Let's examine an example using the S&P 500 ETF, or SPY daily chart, which clearly illustrates the MACD line, signal line, and histogram. The upper panel highlights price movements, while the lower panel effectively showcases changes in momentum through the MACD indicator. One of the primary ways to interpret MACD signals is through crossovers, particularly signal line crossovers. A bullish signal indicating a potential buying opportunity occurs when the MACD line crosses above the signal line. Conversely, a bearish signal suggesting a potential selling opportunity is generated when the MACD line crosses below the signal line. Zero-line crossovers are also crucial. When the MACD line moves above the zero line, it suggests an emerging uptrend. A move below the zero line, on the other hand, signals an emerging downtrend, indicating weakening momentum. Divergences between price action and the MACD indicator can provide early reversal signals, making them particularly valuable for traders. A bullish divergence occurs when the price makes lower lows, but the MACD makes higher lows, indicating fading selling pressure and a potential upward reversal. Conversely, a bearish divergence is observed when the price makes higher highs, but the MACD makes lower highs, signaling waning buying pressure and a potential downward reversal. The MACD histogram also provides insights into momentum. Widening bars indicate strengthening momentum, while contracting bars suggest weakening momentum and potential reversals. The MACD's strengths include its ability to combine trend following and momentum aspects, providing clear visual signals for entries and exits and working across different time frames. However, it also has weaknesses, such as lagging price action due to its reliance on moving averages and producing false signals in choppy sideways markets. It often requires confirmation from other indicators like Bollinger Bands or RSI to improve trading reliability. A fascinating aspect of MACD is its behavioral finance dimension, where its effectiveness is partly due to collective belief among traders, creating a self-fulfilling prophecy. When many market participants act on a bullish crossover by buying, the price may indeed rise, confirming the indicator's prediction and reinforcing its perceived accuracy. This phenomenon reflects momentum psychology, where traders chase trends due to herding behavior, overconfidence, and recency bias, all of which the MACD visualizes. To solidify your understanding, analyze the SPY MACD chart to identify bullish and bearish signals, and explain how divergences provide early reversal signals. Consider how combining MACD with other indicators like RSI or Bollinger Bands can improve trading reliability, and reflect on how trader behavior contributes to its self-fulfilling nature. Thank you for joining this lecture on MACD. We hope this comprehensive overview enhances your understanding of this vital technical analysis tool.